Okay, guys, well, the Fed is at it again, which could mean, well, big news for, well, almost all Americans, pretty much all Americans here, really within the next few coming days here. And I'll give you guys all the information here in this video. As every time the Fed raises interest rates, it affects all Americans. And you might not know this. Well, you probably know this if you've been watching my channel, as I try to keep you up to date here on pretty much everything that is important to most of us here on a daily basis. When they raise interest rates, it affects your credit card interest rates, it affects your car loan interest rates. Anytime you go to buy a new car, buy a used car, lease a used car, every time you go to get a mortgage or refinance a mortgage, all sorts of things. It also affects the government borrowing money and paying interest on their debt. The debt, think about this debt ceiling, and we're to the point now where the government's paying almost $1 trillion in debt or interest on their debt per year. And now, as you can see here, the Fed's Waller, person named Waller, if data stays hot, the Fed policy rate will have to be raised here multiple times again and may have to go as high as 5.4%, which means multiple more interest rates here going in the near future. Bank of America warns the Fed will hike interest rates, quote, to the point of pain, as experts say there's no serious signs the economy is under control. And this means credit card interest rates are going to go up. All these different types of interest rates, personal loan interest rates, everything are going to continue to go up. Here, take a listen.
Well, some of that drive in that 10-year today was what we heard from a number of Fed officials. We heard from Atlanta Fed President Raphael Bostic, also Minneapolis, Fed President Neel Kashkari today, both discussing the stickiness of inflation and what that means for Fed policy. Bostic writing in an essay, quote, "I think we will need to raise the federal funds rate to between 5 and 5.25% and leave it there until well into 2024. We also heard similar hawkish rhetoric from the Fed's Kashkari earlier today.
And so there's a lot of attention to the next meeting in March. Is it going to be 25 or is it going to be 50? I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's much more important than whether it's 25 or 50 is what we signal in what's called the dot plot.
Certainly that has been a focus, the dot plot here most recently. So 50 basis points looks like it could be back on the table. We want to bring in Aditya Bave, a senior economist at Bank of America. Aditya, great to see you here. So just first, your reaction to what we heard from Bostic and also what we heard from Kashkari earlier today, that hawkish rhetoric once again.
Good afternoon. Thanks for having me. I think we split the difference between the two. We actually have 3 more 25 basis point hikes in our forecast. That would get the terminal rate to 5.25 to 5.5%. So that's a little bit higher than what Bostic has, but we're not yet ready to concede that the Fed's going to go 50 in March. So maybe a little bit less hawkish than Kashkari.
And of those comments, what really stood out to you the most? What surprised you? I think the one thing that stood out to me, Kashkari saying the bigger risk is not doing enough. They're not afraid to over-tighten. And, that's something we've heard from Jerome Powell from the very beginning. If they're going to make a mistake, it's going to be on the over-tightening side of the Fed statements today. What stood out to you?
To be honest, none of this was particularly surprising. I think the Fed understands now that inflation is fundamentally a demand problem. They can't hope for immaculate disinflation, as we like to call it, essentially help from the supply side, getting us all the way back to 2% inflation. That doesn't seem like it's going to happen. And as long as inflation is a demand problem and demand shows signs of being sticky, persistent, then the Fed has to keep tightening.
So then, Aditya, that begs the question, how high will rates have to stay in terms of the timeline of that higher for longer, something we've been talking about because of that stickiness of inflation? What are you predicting?
We have the Fed remaining on hold till March of next year, but I think it's better to think about the timing of Fed cuts more in terms of what it would take for the Fed to cut, so thresholds rather than a calendar date, right? So I think the Fed would probably need to see 3-month inflation coming in around 2%, particularly on the core. And the only way that probably happens again is that the Fed finds the point of pain for the consumer. And we seem to be some ways away from that. So our base case, again, has the economy going into a recession in the third quarter of this year. And in our view, that will help bring inflation back down to much closer to 2% by March of next year. But if you don't get that recession, if the consumer remains resilient, then the Fed will have to hike further and probably remain on hold longer.
And getting back to your statement about it being primarily a demand problem, what do you think needs to happen with the labor market in order to bring that inflation number near the target?
The labor market has to slow down. We know that job and income gains are a big driver of consumer spending, probably more important than some of the other stuff that gets discussed around consumer leverage and excess savings and so on. So the labor market has to slow down. We know that the break-even rate of job creation to keep the labor market in equilibrium is around 50 to 100,000 jobs per month. Well, over the last 6 months, we've been averaging 350,000 jobs per month. So we've got some ways to go in terms of cooling off the labor market.
Yeah, so they're expecting more pain for Americans, and they're going to continue to raise interest rates and hold them high for probably at least a year or more. And they're going to do this, and they're probably going to do this. The Fed said that, what did they say there? That if they're going to err, they're going to err on the side of raising interest rates too high or too much. This is just unbelievable. Unbelievable. And who's going to take the error? Who's going to take the burden of this? The low and middle income Americans, the people going to buy food, to people that are just taking the weight of credit card debt, the people that are taking the weight of interest rates, the people that are going to buy a home, the people that are going to buy a car, whether it's a used car, a new car, or anything, the people that are borrowing money because interest rates are going sky high. I mean, we've already seen mortgage interest rates go from 3% or under 3% to now over 6.5. At one point they hit 7%, and now they're going to be, the only reason they actually fell back down is because banks actually seen the over 25-year low demand for new home mortgages, or used home mortgages. I mean, whatever, you get what I'm saying here. Just people going out to buy homes, right? And banks actually took it upon themselves to actually drop their own rates on their own accord because nobody was buying homes. It was like a 25 or 30 year something low. And they just went in their own pocket basically and just kind of dropped the rates on their own accord because nobody was buying homes. The rates just, I mean, think about it. If you're in a home right now and you have like a 3% rate or slightly lower, and you want to sell, but you're going to go from a 3% rate to a 7 or 6.5, it's not worth it. Like literally, people don't want to sell their home unless they absolutely have to move to across the country or something. But if you're just going to move down the street or the other side of town or something, people are just saying it's not worth it because the interest is going to be like $1,000 more a month. It really makes people say, you know what, it really better be worth it to make that decision. And this is why we're seeing such a, I don't want to say a home shortage, but like this is why the market is really, really crazy out there right now for homes. And before this, we were seeing like a price spike in the car market. That's really come down now. Car dealers are really, the market is completely just shifted all over the place. I mean, they remember they were asking over MSRP. We had those chip shortages, and dealers were literally price gouging to the hilt. Well, thank God that has mostly stopped, except for maybe some like one-off high demand cars that are special editions and stuff like that. But thank God, I mean, they were just charging over MSRP for just like regular Buicks and Honda Accords and Civics and just like regular cars. I mean, and they couldn't keep them on the lot. Like they were just selling like hotcakes. It was insane. It was just madness, madness. So the problem here is that now everybody's paying for it except for like the ultra rich who don't pay interest. Yeah, so my advice, if you can, pay down your credit cards or pay them off because if anything, if you have credit cards and you go to the grocery store, or you go to buy gas, or if you can, and if you use your credit card and then just pay it off every month, and if you have a rewards card or any type of credit card that gives you any type of rewards, if you just set it to auto pay in full every month, the credit cards will actually pay you. Yeah, because they'll give you that 1% cash back or the 2% cash back or airline miles or whatever they give you. I personally prefer cash back because it's just, and I just have it, they can credit it to right to your account actually, and it just gives you money off your bill. And airline miles and stuff like that is just too complicated and ain't nobody got time for that, right? Just give you the cash back right to your statement, and you literally just see like it's just a savings. It's awesome. So instead of you paying the interest, they pay you to use the credit card, and you can just literally set your bill to auto pay, just auto pay it in full, and then this way you're basically on a cash system. It's like going to the if you go buy $100 in groceries, it's like paying cash. You're just using your card and you just have it set to auto pay. Of course, you got to make sure you have enough money in your checking account and stuff like that. But if you're in the position to do that, it's really, really good. If you're not in the position to do that and you go buy the $100 in groceries and you pay with it with a credit card, the average credit card is at 20% interest now. That means you're paying an extra 20% every year on that $100. So you're actually paying $120. And if you take more than a year to pay it off, then you're paying $140 and then $160, then $180 for that $100 in groceries. So if you think inflation is bad now, you're actually paying 20% more every single year it takes you to pay that off. And if you pay the minimum, I think it takes like what is it? It's like 20 years to pay off your debt if you pay the minimum. Yeah. And by the way, if you think inflation's bad here, if you've been watching my channel here, you know inflation's bad all over the world. Take a look at this. I seen this here the other day because, again, I just do research and I just kind of see everything. This is from Reuters. I mean, they're not political or anything. Pakistan's February CPI, which is basically their inflation number, went up 31.5%, the highest rate in nearly 50 years. So I can't believe it was even higher than that 50 years ago. But nonetheless, you know how our inflation was at 7, 8% and it's around that, and the raise for Social Security was 8.7%. Well, their inflation's at 31.5%. So that means in 1 year, their money is now worth 31.5% less. Wow. It's literally unbelievable. Their food and beverage and transportation prices surged more than 45%. Wow. Absolutely unbelievable. Thankfully, here in the US, gas prices have come down a little bit. The average gas price here for the US is $3.39 for regular, and a month ago it was $3.49. So it's come down 10 cents here in the last month here. Diesel's at $4.38, so $1 higher, which is still insane to me because it's literally just price gouging because diesel takes less refining to make. So still pretty insane to me. But a month ago, diesel was at $4.66, so $4.38 is better than $4.66 a month ago. But a year ago, diesel was $4.11, so $4.38 to $4.11, not as good there. But regular gas is better because regular gas is at $3.39. A year ago was at $3.72. So you win some, you lose some. So I'll keep you up to date here. If you appreciate these videos, don't forget to hit the like button for us. And if you haven't yet, make sure to click the subscribe button and then the bell icon that appears after you subscribe so you don't miss out on new videos. It's completely free to do so. Here's some videos you can watch next. Here's some really big information here on Social Security that you can watch next if you haven't yet. And there's actually some good news in that video here as well for millions of Americans. And here's a really big video about Russia and Vladimir Putin and Russian state TV. If you haven't watched that yet, click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.